Okay, hello everyone. Now we will start our live session today about financial analysis. So in this live session, I will answer your questions, any questions about financial analysis topics, and please feel free to drop me messages in the chat box. So I will answer your questions, and hopefully some of you are doing the assignment until this stage, so you can ask questions about this part related to your assignment. In the meantime, I will so please feel free to drop me message there, or you can raise your hands or stop me in the meantime, so you can ask any questions that you like. In the meantime, I will analyze or summarize a little bit about this section, and hopefully cover some main points that you at least need to cover in your assignment. So financial analysis, so far in this part, what we will need to analyze is all the information about financial information, right? Before or last week, we learned about accounting analysis, in which we will identify key accounting policies, and then we will identify the key or like areas of flexibilities to see whether firms or companies they follow, or what the strategies that apply to those accounting policy. And after we finish those two steps, we move to analyze the quality of disclosure information or the company information about the strategies, accounting strategies. And after that, we will conclude about whether firms have any potential red flags, right? We can conclude that less likely to have potential less likely to have accounting manipulation or potential red flags, or the company is more likely to have accounting issues. And also we can conclude whether a company has aggressive accounting strategy or conservative accounting strategies. That's all about accounting analysis step. I want to remind you again. And after we know accounting analysis step, we just in the quality of accounting information, and then we go to accounting financial analysis. So in the financial analysis, what we will analyze is what and why. So what does it mean for all the numbers? What does it mean, and why companies report that number? So in general, we ask what happened and why happened. Some and all information on financial statement mainly show us what happened instead of why happened. Some information can let us know why it happened, but to know exactly why, we need to link with other factors, link with the economies, link with lots of things. So therefore, the first step of business analysis is also important for us to explain why. And in the later part, we will analyze one case about fiat that I will show you to look at what and why in the latest in the later part of this live lesson. However, next week we will have another workshop, right? And in that workshop, I will also we will interact, and we will do some like kind of solve or discuss questions about accounting analysis and financial analysis, and also we will analyze more about fiat as well. I'm pretty sure that we will not have enough time to analyze the full case of fiat today. And now we go to the more details about tools and techniques in financial analysis. So we will based on common size analysis, ratio analysis, cash flow analysis, segments, and another part is about credit analysis. So on Moodles, I posted five different files, right? I posted five files for you, and so after that you can, if you're interested in looking at ratio analysis or cash flows or segment, you can watch separately, so please have a look at that. Okay, so I received one question about common size analysis. Is it common size analysis? How many years should we analyze for accounting analysis of group assignment? And can we use 2020 annual report, because some companies do not upload? First, how many years should we use? Normally, we should use from 3 to 5 years, right? When we do, when we analyze over a period, we can use like at least 3 years, but we should use like from 3 to 5. It's up to you. And can we use 2020 for some company? It depends on annual, on whether the firms or companies already reveals information about the financial statement in 2020, right? Because now is in, we just at the beginning of 2021, and many firms are normally, I think at least more than 40 to 50% of firms, they choose 31st December 20, normally at the end of 31st December, and they have around 3 months to publish information. So annual reports of 2020 for many firms, they may be available in March. So, but some firms, they can finish in the ending year in September. So maybe at the moment you can have that already. So it depends on firms. If the firm that you are interested in ended, for example, like December 2021. So the most updated one should be the 2019 one. So you can use the 2019 one to analyze it. And also, as all us know that 2020 is quite a special year to analyze, right? Because a lot of things happens. So I think it can be a separate choice for you to choose firms in 2019. So all the information available in 2020, right? So so it's your choice. You can choose. So to sum up, you can choose either 2020 or 2021. No, 2019. Do we include quarterly report or annual one only? Normally, we analyze based on annual information. Sometimes quarterly information is is helpful for us to look at, but normally we look at annual report. Yeah, so if you find some information, for example, like sales, you look at quarterly, and then you can use some information like that. But the most common is annual one. Okay. Another question is, how many years do we look at as usual? As I mentioned, we can use 3 to 5 years to analyze for a common firms. So you can use 3 to 5 years. Is up to you. And any questions? Please feel free to just drop me a message in the meantime. Okay. So now we will just summarize very quickly about common size analysis and ratio. Common size analysis, when we analyze, right, we know that we need to analyze over time, and also we look at inside firms. So therefore, common size analysis is one is the horizontal time that we will base on 1 year, and then we'll start to analyze. So that's depends on how many years you will base on, right? 3 years or 5 years, that based on a base year. And another is vertical. Vertical is we will use total assets or total revenue as base year, and then we analyze the fraction of each component compared to total assets or revenue. And we also have ratio analysis, right? And the benefits of ratio analysis and also common size analysis is that we can compare different firms. Some firms with smaller size, and some firms with larger size. So therefore, if we use common size and also ratio analysis, we can reduce the size effects between firms, or also different in currency. If different in currency, we can just look at ratio and we can see we can analyze, or we can compare across companies or across time, right? So what I want to emphasize in his again about ratio analysis, perhaps when we study in other courses, we look at different ratios like activities ratio, liquidities ratio, solvency ratio, and profitability ratios. They are they and we also have valuation ratios, but in terms of financial analysis part, we only look at this 4, right? And when we look at this 4 here, we will analyze all activities ratios, liquidity ratio, solvency ratio, and profitability ratios. But in this course, we will start from profit and growth. Okay, we will look at from the aspect of analyst or aspect of investor. We want to see what drive firm values. So therefore, we will start to look at from profitability. And when we look at the profitability, we can start to dig in different ratios like activities or liquidity, solvency, and all activities that we look at in. But we will start from profitability and link with other ratios. Okay, so the structure of this steps is quite different from other courses. However, if you prefer the way to analyze different ratios like the previous one, is still okay. So that's your choice, because different kind of, it depends on skill of analyst, right? Some they prefer to analyze different ratios, but some they want to combine all. So in this course, I approach from the combination one, and because we look at from the combination, therefore we will look at growth and profitability. And when we look at the profitability, the starting point will form ROE. Not when you start to analyze, but when you write report, it's also your options, the way you design it. Okay. And when we look at ROE, we will like 2 steps, right? We have growth and ROE. So you can analyze growth first, or you can analyze growth later, or you can combine 2. And now I mentioned about ROE. ROE, we have in this course, we approach 2 ways. The first is the traditional way, and another one is the alternative approach. And traditional way is we will use the comprehensive income or net profit, and then we divide by average shares equities. The reason we use average one, because income is for the whole year, right? But the average number is at the beginning and at the end, so that 2 points in time. Therefore, we want to match something like for the whole year. So therefore, we we should use the average number instead of at the beginning or at the end. So that's one point. And when we analyze ROE is how much investor receive based on what they or kind of earned based on what they invested at the beginning. So that is a very key performance measure for us to analyze. And as an investor, we're interested in that. And when we compare ROE, we also need to look at the cost of equity capital and ROA, but we will analyze and have some exercise for us to do it. And now we go to the traditional approach. When we analyze ROE, it just not only we look at the ratio itself or the way we look at net income divide the average shareholder equities, but we start to split, right? We want to see the drivers of ROE. So therefore, we start to split both ROA and financial leverage. So by split the number scale by average assets, or we use average assets as the channels or the channel for us to analyze. So based on this formula, we know that ROA is one factor, and another is financial leverage. And let's talk about financial leverage first. So financial leverage, that in general, that is about the way we kind of capital structure of firms, right? How much we raise debt or how much we will raise from equity. But financial leverage in this case, we look at more from the debt holder side or from the interest. And when the financial, so we will ask whether financial leverage or debt is really good for firms. And the way we look at in here is we will see whether financial leverage here is bring more positive or more the higher financial leverage may increase the ROE here, right? But it's still a question for us about okay, so whether we borrow more is good for our for the performance or not. With this formula, we can only say that there's maybe a positive relationship between between financial leverage and ROE. However, we want to see the effects of financial leverage on ROA, right? So to see whether the way we raise debt is bring more benefits for firms or not. So it's reflect in the ROA. And in general, when we look at financial leverage, we will see the interest come from leverage or debt is higher than the interest that we need to pay for banks or bondholders or debt holder. That's from financial leverage. And when we look at ROA here, a lot of information in ROA, and therefore we also need to split ROA to look at further and analyze further. So here is just summarize again that ROE is driven by first from business strategies, right? Is from ROA, and also financial strategies is come from financial leverage. So kind of ROE not only depends on the performance, but also depends on the way we raise capital as well. So now I talk about ROA. So ROA is net profit divided by total average total assets, right? That return on assets. See the how much we earn from the total average that we buy, no, total assets that we invest or we buy in general. So the issue of this calculation is net profit in here. I want to be careful this point a little bit. Net profit in here is the return to at the end, right? That the end number that we distribute to equity holder, but assets is include debt holder and also include equity holder. Therefore, with this formula, there are alternative measure as well. And when we analyze ROA, if you do quizzes, you can see the correct answer based on this approach. This means that we will look at net profit and then we add back interest after tax, and then we divide the average total assets. But it completely depends on your choice when you calculate. Okay, that about alternative definitions of ROA. And for leverage, we can use this formula. I have another questions. For the traditional way or the alternative way for ROE decomposition, which ones used in group assignment? Okay, I will go and then I will answer this part for you. And when we just analyze ROA and leverage, right? And we can analyze further ROA based on net profit and assets turnover. Again, be careful in here. As I mentioned before, when we analyze ROA, we will look at the net income plus worth, the interest after tax rate, and divide average total assets. But every time when we analyze net profit margin here, remember we should use net profit divided by sales. Okay. If we analyze ROA itself, we can analyze based on the interest before tax, after tax, and net income. But if we put in a whole part ROE like this, remember to use net profit by sales. Okay, that what I want to mention. So the traditional approach is we just split into different ways. So before we split net profit and we base on average assets, right? And now we add more assets, more sales in. So the ROE in this case is a product of three different indicators for us to analyze. The first one is net profit. The second one is asset turnover, and then financial leverage. So in here, you can see that we analyze profitability, efficiency, and solvency. And we based on this, we will analyze like kind of we base on the top, right, and we analyze each factor in instead of we write in. The first one is activities, and then efficiency or solvency and profitability. So if we analyze and then we go to profitability, we analyze it again, it's kind of repetitive. So it completely depends on the way you write. If we approach from the top here, it's easier for the reader to follow. Okay, and with that three components, and now we can also analyze 5 components. In 5 components, here worth we based on tax burden and interest burden here. With this approach, we can see how about the tax effects of the tax effects on the return on equity to analyze. And please watch the video the video about this part. I also analyze about this if you find it, if you want to see more. But the limitation of this is again the financial in one activities, in the firm's activities that include financial assets or financial activities and operating activities. But what we want to see is the efficiency of or the effects of different aspects, financial assets or from financial activities and operating activities, how it's really affect how they affect the return on equity. Therefore, we have the alternative approach. The alternative approach is a way in that we need to split operating activities and financing activities. So when we split it and we recast, in general, that term is recast, and then we recalculate the return on equity. And here's the formula to calculate the return on equity, but based on the recast formula. Okay. And here is the formula of alternative approach. And we can see in here it's kind of, now it's quite different, right? We can see the return on business, and we can see return on business and the effects from interest rate after tax and financial leverage here. So in general, we have return on business assets plus spread and times financial leverage. And now, which approach should we use? You can actually we can use both approach. We can see in the the traditional approach based on three components or three factors or five factors what happened, or we can use on the alternative approach that we look at financing activities, and we look at business financing activities and business activities or operating activities. So actually, if you write in a way that you want to see different components of the traditional one, and you want to see how operating activities and financing activity affect the return on equity, you have additional analysis on the using the alternative approach. So therefore, you can use two ways, two methods to apply, or you just want to look at what really happened in the firm. So in general, it means that we will look at financing activities and operating activities and financing activities, and we can still be able to apply the same way as traditional approach. So it means you can just use alternative approach, or you can use just the traditional one. It's completely depend on your choice. My recommendation is first, from my point of view, different approaches have different advantages. So you can combine two to analyze, but don't write repetitive. Some point that we can analyze from the traditional way, we can use in the traditional ways based on analyst reports that I have read so far. And if you like to look at analyst reports, remember to use Thomson Reuters account that available for you on Moodle, with the password as well. So you use remote desktop and look at financial reports. I believe they are very helpful for you to look at information about how real analysts, in reality, how analysts write financial reports. And you can use those reports as kind of a base one for you to kind of a reference for you to analyze. Okay, so look at them. And why I mentioned about financial analysts in reality, because many financial analysts or analyst reports, they use the traditional way. But if we want to see indeed what happened and what really the insight, we have insightful, more insightful information, we should look at also financial information and also operating activity as well. Okay. Okay, so do you have any questions about this before I analyze about the alternative approach for you? So it's completely depend on your choice. Okay, so you can either just based on the traditional approach, or you based on the alternative approach, or you can combine both. Because now we can see why we can combine both. Because when you look at in here, they just split different components, right? They based on return on operating assets and return on investment assets. Here they look at the return on business assets. If we base on the traditional approach, it's that is the return on assets, right? That ROA in here is return on business assets. And no matter the way we look at, either based on the traditional approach or based on alternative approach, we want to look at the return on operating assets here. So return on operating assets here, we also need to base, like for example, sales or sale over operating assets, that is operating assets turnover, and then here is operating profit margin. So very similar way, and return on operating assets here is driven by the strategy, by the firms, or by industry, and normally it changes, right? It changes over time. So that is about, we based on profit margin, and both this information is really similar to return on assets. However, the return on assets look at the whole picture, but the return on operating assets is just classified by operating activities, core activities that generate profit. Some financial assets, for example, like we use some hedging or derivatives, financial assets from derivatives, so that all about financial or financing or financial assets, right? And those financial assets is just investing or investment activity of firms. So those in general return on assets, it just so a whole picture, but return on operating assets is sort of core thing where the firm really indeed based on the core activities, or based on not only core activities but also other activities, or more specific based on investing one. And for the assets turnover, remember that normally assets turnover is it should be comparable between firms across industry, because assets turnover or operating assets turnover is driven mostly by industry characteristic. For example, like let's take a grocery store, right? With a grocery store, we think that, or how about the structure of those firms? How about sales of those firms in groceries industry, and how about whether they will need to invest more in assets or not, because the way they operate is very similar. So therefore, when we scale by ratio, the operating turnover normally should be comparable between firms in one industry. But of course, should be different industry. They have different kind of characteristic about assets turnover, and we will have a look at that during our workshop to know, when we look at in the information, we see which industries should have high assets turnover, or which industries should have or lower assets turnover. And now we turn to assets turnover. When we analyze assets turnover, we will look at working capital management and non-current assets management. So when you start to analyze assets turnover, start to now dig to working capital management and non-current assets management, so the first thing, please have a look at slide that or materials I posted on Moodle. So we analyze assets turnover by looking at first working capital, and working capital will be driven by operating working capitals to sales, or account receivable, inventory turnover, or account payable turnover. So now at this stage, we start to look into working capitals or activities, right? And we also have financial leverage analysis, and we look at liquidity analysis and solvency analysis. So please have a look at slide. If you have any questions, please feel free to ask me in the next workshop. How we analyze each, and when analyze liquidity, we have lots of ratios in, right? So we finished the ratio analysis. Because ratio analysis, of course, that one of the most common, or to say the most common choice of when we analyze financial statement. However, ratio analysis is also subject to certain limitation, right? And therefore, we also need to look at other information. For example, we look at cash flow information. Cash flow information, for example, at the moment, there are a lot of firms, just like investor that we check, not invest, okay? Or even we, as an investor, you know the difference between trader and investor, right? Even one investor, if we're interested in a company, a growth company, and a growth company at the moment they have negative cash flow, and they have negative earnings. And what negative earnings, we can't use earnings to forecast about the future. We also can use PE to value firms, or any future cash flow to discount to present to identify the present value. So how we know and how we analyze those firms. And I believe that cash flow analysis is one of a good way for us to analyze some special firms, because when we look at cash flow analysis, cash flow information, sorry, we have three information, right? Operating activities, investing activities, and financing activities. The combination of all this information will give us which state of that firms and financing position of that firms and investing activities of that firms. For example, like when we look at cash flow from operations, positive cash flow from operations, we know that those firms in the mature stage already, and the negative one is growth that is growth firm or young firm, right? But now just look at the growth one. And now we see that all negative cash flow from operations. So should we invest in that companies because those company growth and then good in the future or not? Now we look at investment and financing activities, right? When we look at financing activities, we see that got a lot of positive financing activities, and we see like whether this firm they raise from debt holder or whether this firm raise from equity or shareholders. And you can read in financial reports and see that if the huge amount, but it comes from two sources. I mean that from debt holder and from equity holders, you can conclude that also not only investor believe in that firm, but also debt holders, they also believe in that firm. Normally debt holder, they're very kind of conservative, right? They want to see whether a certain firm they will be able to apply the obligation in the future or not. But if we look at financing activities, and we see that they have sources from or they have money from investor and debt holders. It means that debt holder at the moment they still have shares, or they still have a certain belief that in the future this firm will grow. So this can be a good company for us to analyze, or a good firm for us to invest if as an investor we look at financial information. But if negative growth, negative cash flow, but we also have negative financing activities, of course, at that time the firm's really in a trouble, right? And negative. Now I just mentioned about operations and financing, and how about investment? Investment, normally we expect that investment should be negative, right? It's different from the other two, because if it's negative, it means that the money flow out to invest in firms' activities more. Okay, so that about cash flow analysis, that important to look at. And we also, if if your firm, the firm that you choose is the domestic one, they just focus on the domestic market. So we don't need to consider about segment analysis. But if they kind of multinational companies worth lots of segment around the world, segment analysis is also worth to look at. Why it's worth to look at? In this slide, I don't have an example, but if you look at investment investment strategy of asset management firms, some firms, they will analyze for every quarter, they will have strategies to provide information for investor to invest in their firms or in their fund, or in the mutual fund. So when they will say that they will put more outweight in one areas, and they reduce outweight in investment weight in a certain area. So for example, like if I'm not sure whether on Moodle or not, but if you look at JP Morgan recently, JP Morgan Assessment Management, they decided to reduce the weight to invest in UK stocks, but they put more in other countries. And if from the point of investors, should we invest in UK firm or not? Of course, we're concerned at the moment, but UK is quite slow, so we make and also the characteristic of the market, we tend to prefer to invest in US stocks, for example. But if we look at in the segment analysis, the segment information, we see if those firms, they operate around the world and they have a lot of sales from, for example, like they have sales in Europe, or they have a lot of sales come from the US. So actually the firm itself is diversified, right? So invest in those companies is also the way, a way to diversify our portfolio as well. Therefore, it's also important to look at segment information when we analyze. And furthermore, if the segment information, for example, with a certain firm, at the moment, when we read news, we know that for example, like Myanmar at the moment, the economy or kind of the political issues in Myanmar, right? And if a certain firm that invests in Myanmar with political uncertainty at the moment, this may affect their sales. And therefore, if a lot of kind of a high percentage of sales sell to Myanmar, and from the point of analysts at the moment, we may raise concern about those firms and then may affect the forecast of sales in the next step. So therefore, it's important to look at the sales structure of a certain firm, if they are not certain firm, of firms of diversified firm. Okay. And next step, after we analyze all, we also need to look at credit analysis. Credit analysis, in here we will we can analyze in the step of financial leverage, in which we look at short-term liquidity and long-term solvency risk. But so this step, we don't need to write again about short-term liquidity or long-term solvency risk. We can mention that in the financial flexibility, we see this, we see that, both. We don't do again. But in this step, we will analyze credit risk and bankruptcy risk. Okay, and to do credit risk, we can check the credit history, like whether S&P rate for that firm BB or triple A or A minus or something. But another way we look at is we look at based on the type of errors model here. But the most common one we use is we will based on Altman Z-score model. Atman-Yesco's model here, remember, in here when we analyze credit analysis, okay? So you just use this formula based on working capital over total assets. All this formula apply into this Atman Z score, and then conclude whether have high probability of bankruptcy when Z score smaller than 1.86, or low probability of bankruptcy, or just in the gray area. So that we also have the profitability of bankruptcy that I also saw here worth lots of formula here for you, and I believe that with example for you to look at. So please have a look at those formula to do financial risk analysis or credit risk analysis. Okay, so that's about the main idea today. Do you have any questions? So there are lots of things to do in financial analysis. And remember to see the word limits, how many words that you should allocate in that part, and the way you analyze, okay, and follow the guidance. The guidance very clear for you to follow. So do you have any questions before we move to a case, an example? So an example, I posted on Moodle already. There is a fiat case in 2008. Why I choose in 2008, 12 years already. First, the first thing is there is a case from valuable books. The problem 4 of the chapter. So if you want to have a look at that, it's there. But another thing, another reason I choose this case is in 2008. And we know that the global, the financial crisis is around that time, right? And now we in the kind of not about financial global crisis, but in here is we in the pandemic crisis. So therefore, the way kind of similar when we look at firms during financial crisis and firms due to the global crisis about the pandemic crisis. So now when we let's look at this firm. Actually, for this case is they mention about the merger between Fiat and Chrysler, and at the moment they merge already. So we have the information of this firm in 2006, 2008, and 2008. During this period, kind of crisis, pre-crisis, but sometimes crisis got lag. It's happened, and then at one point it just happened. So we have income statement, and we have balances, and we have cash flows, and also have additional information here. Additional information here is extracted from the financial statement. If you're interested in financial statement or annual reports, it's already available for you on Moodle as well. So now let's look the requirement of this. The requirement is decompose fiat, return on equity, and evaluate drivers of the company performance during the period, and identify a company performance and how it's affect and the effects of credit crisis on fiat. So if you choose a firm that report their financial statement like kind of in September 2020 or June 2020, somehow it's got some they mentioned something about pandemic crisis already. Okay, So now we will look at so for the income statement, and we have the condensed income statement here. The condensed income statement is the way we recast financial statement. We don't use the previous financial statement like this, but we recast it. And it's also start from revenue. And we need to calculate interest expense after tax and net investment profit after tax. So therefore, we will split operating activities, and we also split investment activities. And to calculate the interest expense after tax, here we will base on the interest expense. Okay, and we can find the interest expense information in both one here. Okay, and I will upload this after next week, so you can have an example to do if you do ratio analysis based on the alternative approach. And we need to rearrange everything look like this, and to have a final is the net operating profit after tax. Please prepare the exercise, have a look at, and see how to arrange it, and please ask me a question how to do if you don't know. Okay, so again, we need to split between operating activities and investment activities when we do the condensed income statement. And it's the same with the balances one. With the balances one here, okay, we have the total assets, and we also have until here total shareholder equity and liability. So it's the end of the normal statement. So we, for the recast balances, we will analyze the net working capital here, net non-current operating assets, and then finally we have total business assets, and we split to have the total capital. Okay, and please have a look at the slide. What I remember what the and the books, what the classification of how we classify different items in operating activities and in investment activities, and that will be your exercise to do at home for this part. Okay, and for the cash statement, we don't need to split between income statement or between operating activities or between the investment activities. And after we recast, we will start to do ratio analysis. Okay, and we will, and based on this process, you can see the return on equity here is exactly the same as the return on the financial, the return on equity if we use the alternative approach. Okay, so please prepare the assignment, or not assignment. Please have a look at those slides, and then we will analyze the ratio analysis in the next section. Okay, next week. Okay, so do you have any questions? So hopefully it's clear for you to know what you should do. Yes, please.
Hi, I'm wondering if we need to like follow the exact process or template that is provided on the assignment sheet. Like there is very clear points that we need to include, and do we need to like follow that throughout the report?
Yes, we highly recommend you to follow the guidance, because the guidance is the way for us to mark the assignment as well. Okay, so please follow the follow guidance and cover all the points in the guidance.
Okay, sure. And also, I was just wondering, what does it mean by the consistency throughout the report? Say, if we recommended to buy this stock, do we need to like only focus on presenting the good side of the story and just completely like try to like not present or try to?
Yeah, kind of for this assignment is you will need to produce an analyst report, and when we finish the financial analysis, you will start to forecast, and based on your forecast model, you can do the valuation, right? You can apply to do valuation, and when you have the intrinsic value, you will need to recommend whether you will buy, will sell. Buy, sell, or hold those stock. So that your assignment reflects the whole all contents covered in the course. So yeah, you need to recommend.
And what about in case of their like company introduction and business strategy and all? Do we need to also consist or to support the recommendation that is in place?
Sorry, I can't catch the ball. What does it mean?
It's like for the second part and second or maybe third. Sorry, the second part, we need to do some company background introduction and business analysis.
Yes.
So this part also need to support the recommendation.
No, if at the end for the company that you choose and you identify the intrinsic value at that time, if you just or buy, so you don't need to support. So it just we will look at from the fair point of view. We analyze and we give the recommendation.
All right. And what about in case like some company has like the perfect financial statements and all, but maybe there are some issues with their operatings or moral issues, environmental concerns. Do we need to disclose all of these concerns, or we put it all together as a risk concern?
That is the quality of disclosure information, right? That in step 4, so you can raise the concern about the disclosure information, the quality of disclosure information. That's it. You can raise your concern there.
Absolutely. And also, I was just wondering, would this report be like graded on the extent of biasness or something, or does it only consider the style of the report and the accuracy?
Actually, it completely depends on your skill, right? So you need to first you follow the guidance. You cover on parts, but somehow it also reflects your skill to analyze certain firms. Well, for example, I do financial analysis, and then financial analysis is just the base step for you to forecast, and then you somehow is both reflect your skill, but also the accuracy. But actually the accuracy we forecast something in the future is also uncertain, right? So somehow you just need to explain the underlying reason why, and it just shows your skill. Yeah.
Right.
We try to have the most accurate report, but just make sure that all information explains why, and when we read it, we can see it's a high quality report. We can trust the information. That's it.
All right. Thank you.
You're welcome. Yes, please. Any questions? Please feel free to.
It's me.
Yes.
I want to know, where could I find the Excel you just showed?
On the Moodle page. On the Moodle page in the example was the fiat case. I got Excel file, but the solution I will post after this live session. So you have a look at that, and then we will analyze in the next one. Okay.
So mean you will not upload this Excel? Or?
I will upload the Excel after this live session. So you will have after this live session. At the moment on Moodle, got a case for you to read. However, the solution will be available after this.
Okay, thank you.
Okay. Yeah, so you can base on that to look at the way to analyze, to construct ratio sorry, the alternative approach. So that's the way for you to practice. And based on, please have a look at that. And next week we will analyze the meaning of each in the alternative approach.
Okay, thank you.
Okay, yeah. So we use Atman Z-score or logic model for credit analysis. I heard you mention to use Z-score, but I'm afraid I didn't hear clearly. The question, the answer is that's your choice. Yeah, but Atman Z-score is one of the most common model we use. So therefore you can use Atman Z-score. Okay, but you can use both model. You can use logic as well to make sure that it's you got consistent results from two models. Yeah. Any questions? Okay, so you have an exercise session next week. So please have a look at my the Fiat solution that I will post after this session, and we will analyze the meaning of each ratio in. Okay, so today I just discussed, or I just mentioned to you about, that is the way we use. So that's based on formula, but no meaning anymore. Next week we analyze the meaning, the underlying meaning. So have a look at that. And next week we'll also discuss about example, for example, what different industry, which industry with high turnover assets or assets turnover, or lower something. So next week is about exercise. We applied what we learned this week in this week. Okay, so please prepare and ask me about those example or those exercise. Okay. Okay, so that's it for the live session today. Thank you very much for attending the live session, and I will see you next week. After I think the next week session will be at 2 or 3 something, right? So see you, and yeah, bye bye.